Lessons from history's greatest investors. If you study history closely, you'll notice something surprising. The greatest investors rarely won because they were the smartest person in the room. They won because they consistently did what most people found emotionally difficult. While crowds chased excitement, they embraced patience. While panic spread through the markets, they stayed calm. That difference, repeated over decades, created extraordinary wealth. Take Benjamin Graham, often called the father of value investing. His philosophy wasn't built on predicting the future. It was built on accepting that markets are emotional. Prices can swing wildly, but a business's true value changes much more slowly. Graham taught that the market is there to serve you, not instruct you. That simple idea became the foundation for generations of successful investors. His student, Warren Buffett, took that lesson even further. Buffett didn't become one of the world's richest people by making thousands of brilliant decisions. He became wealthy by making a handful of exceptional ones and then giving those investments time to grow. In a world obsessed with speed, Buffett reminds us that time is often the greatest investment advantage. Then there's Charlie Munger, who believed that avoiding stupidity was often more profitable than chasing brilliance. Instead of constantly searching for the next big opportunity, he focused on avoiding emotional mistakes like overconfidence, greed, and impatience. It's a mindset that sounds simple, but it's remarkably difficult to practice when markets become unpredictable. History offers another powerful lesson through John Templeton. During times of extreme fear, when headlines convinced everyone that the future looked hopeless, Templeton searched for opportunity. He understood that the best bargains usually appear when optimism disappears. Buying during uncertainty isn't comfortable, but history repeatedly shows that courage and careful analysis often go hand in hand. Howard Marks approaches investing from another angle. He reminds us that risk isn't about volatility, it's about the possibility of permanent loss. Great investors don't chase the highest returns. They focus first on protecting their capital because they know recovering from a major mistake is much harder than missing a temporary opportunity. When you look across generations of legendary investors, a pattern emerges. Different personalities, different strategies, different decades, but the same habits. Patience over impulse, discipline over emotion, independent thinking over following the crowd, continuous learning over certainty. Perhaps that's the greatest lesson history can teach us. Investing success isn't reserved for people with perfect predictions. It's earned by those who master themselves. Markets will always change, technology will always evolve, and headlines will always create noise. But human nature remains remarkably consistent. Learn to control your emotions, think long-term, and let time become your greatest partner. That's a lesson every legendary investor would recognize, and one that never goes out of style.